This video, traders, going to look at 5 things to watch out for when trading short versus trading long. Stay tuned. Hey traders, warm welcome to you. All right, so some of the things we've got to watch out for trading on the short side versus trading on the long side. Now, this isn't really the same for trading a forex pair, because obviously when you're trading a forex pair, you're trading one against the other, so you're almost pair trading, if you like, anyway, trading a ratio, whereas exchange rate, whereas if you're trading an asset like the futures, DAX futures, if you're trading a CFD or a spread bet, by the way, check out our channel sponsor in the description below if you're interested in spread trading, spread betting, CFD trading. But if you're trading something like that, like an asset, like an index, then this is really what it's all about. Because most people, don't forget, when you're trading, those things are net long. You know, the universe is generally going to be hedge fund managers, mutual fund managers, pension funds who have stock and are trying to limit losses but kind of maximize gains by going long. Of course, some hedge funds are short as well, but generally speaking, people own stock as opposed to being short stock. So if you look at it from that perspective, it makes a lot more sense. Now, it's not to say that when you're in some commodities or you're some currency pairs, that this doesn't still work in this manner, but it depends on who the participants are and how it's positioned. But some of the things that I've kind of outlined anyway, guys, are counter trend rallies. So when you're in a short environment, let's say your stock is hammering to the downside, let's say even this is a swing trading chart, very often you get these brutal counter trend rallies that are hard to hold on to if you're already short. So some of these stocks, like some of the stocks that we've now seen that have gone almost bankrupt, on those downtrend moves where they've just got hit and hit and hit, they've had counter trend rallies where they've almost doubled. I think of some UK stocks, for example, like Mothercare, for example, a famous UK brand that sells baby goods, really, really struggling brand. In fact, I don't even know if I think they've closed those stores now, even if they're still around. But the point is, on that chart, literally downdraft and monster rally, which would really rip the faces off of any short who were kind of too late to the party, lose your money. And that's why it's become so challenging as well, timing this stuff. Counter trend rallies are so strong, which also means there's opportunity on the upside as well. If you see a counter trend rally, say you are swing trading something, the momentum by the amount of shorts that are trapped because they're too late to the party on that phase, later on they get their chance again, but that phase really causes a lot of short covering, a lot of panicking, a lot of moving. Very often, guys, it's a catalyst as well. So if you look at stocks that are in trouble, there's some sort of rescue package or some sort of restructuring of debt which causes that counter trend rally, that aggressive counter trend rally. And also we see it intraday. If this was a Dow chart, very often you see this at certain times of the day, a spike up, a counter trend rally. So it just seems to be something that happens on the short side only. Now, obviously you do get pullbacks on the long side, but more pronounced when you're trading short. The second thing is markets go lower than you think. So this means that, especially if you are on the short side, and also if you're thinking of trading a counter trend long and trying to find that sweet spot, which be careful of, because if you, let's say we're talking about a stock or we're talking about an intraday chart, unless there's some kind of reason to buy, you've got to be super careful, because markets can go so much lower than you think. Even intraday, you see markets down to 300 points, and that's pretty low. It does another 100, another 50. You think, whoa, that's really stretched. Same with swing trading. We see stocks that have come half from the highs, or 70% of their money from the highs. You think, oh, it's a bargain. Well, the thing can still go to zero effectively, or close to zero. So it always goes lower than you think. And don't forget, it's not necessarily a rational decision, a rational price movement. I think that's more exaggerated as well on the short side. And people are a lot more irrational because they're thinking, I've got to get out. It's more fear, more emotional trade on the short side, especially if you're talking about a stock. Pension funds, hedge fund managers, mutual funds just want to dump and get out and have nothing to do with it anymore. The other thing is short, sharp bursts. So we often get this where we see big moves in one direction, then a kind of pause, then a big move again in the other direction, like a big candle, maybe a little creep up on low volume, then a big candle. See it again in intraday charts and on the swing trading charts. Daily time frames for your stocks. You see like big 2 or 3 days down move, and then it just creeps, and then a big 2 or 3 days, and often again catalysts, guys, news hitting it, bad news hitting it. The fourth thing is increased urgency towards the close. So what I mean by this, on the intraday chart, you very often find that compared to a uptrend day where we just kind of close maybe at highs and it wouldn't be much action, very low volume, nothing much is going on, you often find there's a lot of urgency into the close on a short selling day. So it's a real heavy down day. And I'll talk about this actually, you've got a whole new module in the price action program. We talk about trading heavy down days, and one of the things to talk about is this urgency towards the close and how to position for that. And it's literally because once the bell goes, that's it, guys. You can't trade stocks anymore. Of course there's after hours sessions, of course you can trade futures, but liquidity dries right up. There's so many reasons why people don't trade after hours. Hedge funds can't get the trade stuff. Some of the algorithms don't work on some venues. You get the idea. So the bell is really like, right, no more trading, guys, that's it. So that's why people generally have a lot more kind of urgency to get the order done into the close, and why we see very often, on a down day, a real further hammering right into the close. And I've seen some days, guys, especially back in the kind of financial crisis, where we just saw the last hour or the last even 10 minutes was just relentless selling, relentless stuff. And number 5, guys, is Rallies trick buyers. Stops add fuel. So what does this mean? So these counter trend rallies that we see intraday charts and on those daily charts, they're pushing up. It encourages buyers in. Buyers think it's a bargain. Buyers think it's the bottom. They take the easy kind of trade. They see this and they go, oh, look, that's a lovely bottoming pattern. And in reality, that is just sucking people in, and then you get often very heavy selling. And of course, where's everyone got their stop who's buying on those counter trend rallies? Of course, it's going to be under that low, and that adds fuel to further down move. So not only then do you have this counter trend rally sucking people in, going higher than you expect it to do, because very often people are going, oh, it's a great bargain, and short sellers who are kind of a bit late to the party as well are getting hurt, as we alluded to earlier. But also these guys are all putting stops in here. And of course, as it starts to come back, those people late to the party, they're buying, are getting stopped out. And think about that from a supply demand perspective, where the buyers coming from. The buyers are less likely to come in because most of them have already been watching this and come in here. And as it's starting to really go lower, you've got a one-way street pretty much, because most of the buyers are thinking, this is hurting, I need to get out, No fresh buyers are that excited by it because they've already seen it go up here and they've seen lots of stuff that's not great about the chart. Maybe there's been some sort of negative catalyst hitting that there as well. Of course, they're all stops there, so you now have shorts that smell blood, that press it into the lows. You have a lot of people who are buying and of course having their stops on the lows, and that adds fuel to further down moves with price. So you've got to watch out for that. Those rallies really they're interesting. If you find them confusing, don't be afraid to just not to avoid it and say, listen, there's a counter trend rally, I don't know, is it going to reverse, is it going to come back, and maybe wait for the back end of the move. So if you're out of the trade here and it starts to roll, then maybe rather than trying to pick that turning point there, which is something I quite like to do, maybe wait until you see some momentum to the downside and kind of join that and use a tighter stop on this, looking for fresh lows. That might be a better way of kind of trading it and approaching it. So anyway, guys, those are 5 things to watch out for when trading short. If you haven't checked out our channel sponsor, please do so. It's in the description below. And if you have any comments on this video, of course, comments are more than welcome. Always interested to see what you guys have got. I think I've got some of the most astute and clever subscribers out there. Some of the comments are fantastic and really shows that you're kind of thinking about your trading, and you've got some real great traders out there. So yeah, comments in the comment section below. As always, guys, take care, keep your risk managed. I'll see you in the next one. Bye-bye.